afternoon, everybody, and thank you for joining. I think this is our approximately our 32nd webinar since the start of Corona. About half of those have been in Hebrew, half in English, and some of them have specific product emphasis or asset class emphasis. This call is a general sort of market chat about some of the topical things that we're talking about with clients and in the office. And I'll try to keep it under, I don't know, somewhere between 30 minutes and 45 minutes with questions. And again, it's not a deep dive, it's a general chat. I'm going to talk about asset classes in Q1. We're going to talk about inflation, buying expensive stocks, the US dollar, bonds, a little bit about the Israeli market, and even a few words on Bitcoin. Okay, so let's go on. All right, so there we go. Okay, so significant events in the first quarter. In January, it was all about GameStop, which, you know, pretty unknown company, traded between 15 and 20, went up to 350. It was lauded as the man in the street using social media versus the hedge funds. That was the sort of headlines. And it was some sort of, you know, it was positioned as a major stock market event. I don't think it was a market event at all. It shows me two things. One, in a risk-on environment, you get to see silly things. You get to see some crazy things. And I think GameStop is just one of those things. The other thing is that the power of social media in financial markets is the other takeaway lesson. I think that social media has the ability to really influence one particular company, but I don't believe it can influence the market as a whole. So even if there were people promoting the stock on social media, which if you were a regulated entity could get you into a lot of trouble, but these people are not regulated. It's just the man in the street chatting, and they pushed the share up. So not a big deal in my mind. Then in March, and we actually received a question about this in the registration process, there was this family office, which I think is more like a hedge fund, that went bankrupt. And the question was is this a systemic event or a sign of bigger trouble? And I don't think it is. I am concerned to see a bank like Nomura and Credit Suisse rack up the losses that they did with this thing. You know, these banks are heavily regulated. They're very bureaucratic. It's not easy to circumvent their risk management procedures. But I guess to a certain extent, we have to accept that if you're going to be lending money to hedge funds and things like that, then occasionally you won't. You're gonna get it wrong. So not a systemic event, but again, another sign of silliness that on a risk-on environment. A very significant thing was the approval of the fiscal package led by President Biden. 1.9 trillion, that's a huge number. Some of that is immediate in the form of stimulation checks and helicopter money to the American public. And some of that is infrastructure spending, environmental spending, which will be staggered over a number of years. So the takeaway message there that this is a sustainable level of government intervention and spending, which should be a good thing. The most significant event of Q1 was the rise in the 10-year interest rate from 0.9 the beginning of the quarter to 1.7 in the end of the quarter. This is at the back of inflation rumors, and we anticipated some interest rate rises, but this is more than we anticipated. Just to remind you that short-term interest rates are set by the Fed, long-term interest rates are set by the market, and the market sets these interest rates through buying and selling of bonds. If you're buying bonds, you push up the price, and therefore you push the yield down. If you're selling bonds, then you push down the price and you push the yield up. So there was selling of bonds in anticipation of inflation, and it was more selling than was expected. So it pushed out the 10-year yield to 1.7. So it's a very significant move. We've seen it before, not many times, approximately, I don't know, 10 times over the last 25 years, we've seen a swing like that, but not often in such a short time period. So a big swing in the bond prices, and this affected bond investors. So I'll show you how it affected investors, but this was the most significant event. With respect to the virus, the reproduction rate of the virus is now back above 1 globally from a low of 0.87. Just to remind you how this works, if the reproduction rate is above 1, the virus is growing. If it's below 1, the virus is shrinking and dying. In the United States, it's above 1 again, despite the pretty extensive rollout of the vaccine there. Israel, 0.43. If that continues, the virus will be behind us in a matter of months. The UK is in the right direction with 0.82. With the virus out there, it delays the full recovery. So I think that in the United States, which is the center of our thinking, I think for the better part of the next year, we'll still be talking about the virus. It's going to be slow. So the background will still include the virus. Okay, I've entitled this presentation, "This Time is Different." And the reason I did that was because a couple of people came up to me in the same week and said, "This time it's different," all right? So the client perspective is the market is high, assets are expensive, the stock market's high, look at the profit multiples, bond market's high, look how low the yields are. I must sell everything. I'm going to watch this from the sidelines, okay? I've actually heard clients say that to me, I want out. So the good advisor says, well, it's impossible to time the markets. You need to invest for the long term. And you can imagine a conversation between an advisor and a client in 2007, before the financial crisis. The advisor is saying, think long term. And the client, he says, okay. So what happens is in the short term, the client might be right. We might have a crash of some sort, but in the long term, the advisor is right. And it's all about time in the market, not time of the market. And I think that this sets the background for what it means to invest now in this rather strange environment, because things are expensive. Objectively, the market is high, okay? And now we as investors, we have to decide, how can we make money in this environment going forward? It's not about timing it and sitting outside of the market. And that's why I think that this time, perhaps it's no different to any other crisis that we're not really facing a crisis, but we're at high levels in the market. So maybe this time is no different to previous times. However, having said that, I'll tell you why I think this time is different, okay? And that is because we have unprecedented government intervention in the economy and markets, okay? I will go so far as to say that the markets are almost artificial because of the extent of government intervention. The economy is not artificial, but markets have an element of artificialness to them through the monetary policy and fiscal policy. Monetary policy is low interest rates and bond purchases, sometimes called quantitative easing, sometimes referred to as printing of money. And fiscal policy is generally low taxes and spending. So we're seeing huge amounts of fiscal expansion planned, all right? We haven't seen this type of fiscal expansion since World War II. The numbers thrown around are as significant as post-World War II expansion. But we've never had the combination of aggressive monetary policy and aggressive fiscal policy at the same time. That's just never happened. We've had aggressive monetary policy post-2008, and those were the years of trying to hold back the spending. Now we have huge amounts of steroids in the market, and this should provide an overall backdrop of confidence and favoring risk assets. Okay, that is the big picture, the big takeaway. But we need to say that we have no historical reference point or playbook for this type of intervention. In addition, there's a lot of cash seeking returns. I know this from my experience of dealing with high net worth and ultra high net worth clients. with the institutions that I'm exposed to. I heard a call with the CEO of BlackRock the other day, and he said there's $18 trillion worth of bonds invested in negative yields. 18 trillion. So there's a huge amount of money that's earning too little or nothing, and will, if the market sells off, this money is expected to go into the risk assets and provide some sort of volatility dampener. Let's just review stock markets since January 2020. Okay, so we've got a little bit of a time perspective here. You can see I've shown the red line is NASDAQ, the dark blue is S&P 500, the green is MSCI Global, and the purple is Tel Aviv, and the light blue is Euro stocks. The first thing to note is that everything is at its all these 5 indices are at their pre-COVID levels. We're now above where we were in January 2020. It took some them longer than others to recover. And you can see very clearly that NASDAQ or technology stocks, high growth stocks were the clear winners. It wasn't a straight line. If you look at this area here around about August, September 2020, and again here in Q1 in late Feb, early March, we saw some pretty aggressive selling off. Now, this is these high growth stocks reacting to the interest rate increase that I mentioned earlier. Okay, but still very strong performance from the NASDAQ. S&P 500 is positive territory, 21% since January last year. It's about 6% this year, and doing fine. 6% annualized is 24% on an annual basis. So actually very, very strong results for Q1 from the S&P 500. Tel Aviv 125 in Europe, lagging the rest, but a nice little catch up in Q1, particularly from Europe. Let's just have a little drill down into Q1. So what you can expect to see when you get your reports for the end of March. So USA stocks, as I said, the S&P 500 plus 6% annualized. That's a phenomenal number. Global stocks also very strong. The global stocks represented by the MSCI, it's roughly 50% USA. And it came out for the quarter at 4.67. Euro stocks did even better than the USA, but as that graph showed, they've got more catching up to do. Emerging market, not a fantastic result, but certainly not bad on an annualized basis. NASDAQ, 2.95, having given up a lot of performance at the end of February and March, so still positive territory. The USD, that's the currency itself versus DXY. DXY is a basket of currencies. It's roughly 55% euro and then all the rest. The story there is in December, the talk was about the future of the dollar and how weak the dollar is and how weak the outlook for the dollar is, et cetera, et cetera. But we saw a nice rebound in the quarter. Some of that is because interest rates went up, money went into dollar out of euros, chasing that higher yield and strengthened the dollar. Our view on the dollar, it's still the world's strongest currency. It's a long way between first place and second place. And even though the balance sheet of the United States is a hell of a lot weaker than it used to be, the balance sheet of most countries is weaker than they used to be. And therefore, on a relative basis, and currency is all about relative basis, we don't expect a major destruction of the dollar, which is what people have been talking about, really. Another fascinating part of Q1 is negative result on gold. Gold is down 6% for the quarter. In a quarter where the whole story, the whole theme of the quarter was higher inflation expectations, which led to a sell-off in bonds, which led to higher interest rates. Okay. I've long held the view that the link between inflation and gold is broken. Okay. There are too many variables affecting the gold price to say confidently that gold and inflation have a link. From 2008, or the global financial crisis, when they started quantitative easing, when they started the printing of the money, people said gold is the future. From then till now, inflation has been pretty benign, 1 to 2%, and pretty stable, not very volatile. But gold has been all over the place. Gold, it's been up, it doubled at one point and then halved and all over the place. So the linkage between gold and inflation for me is broken. And another point, if you believe that gold is going to protect you from inflation, you need to hold a lot of gold. So what we see in some people's portfolios, they're holding 3% or 5% of gold, a little bit of a speculative play. That's not going to protect you from inflation. If you want to protect yourself from inflation using gold, you need to hold 30 to 40% of your portfolio in gold. And that's going to create crazy volatility, completely unpredictable portfolio. And that's not what our clients want. So even if I did believe it, I still wouldn't buy the gold that's required if you believe that gold can protect you from inflation. Okay, so global bonds, this index here, minus 4.5%, you can see the pain. Now, minus 4.5% for bonds is huge. It's a disaster, okay? We don't expect to lose, a bond investor doesn't expect to lose 4.5% in a quarter on bonds. Now, why is that? The global bond index has a duration of about 8 years. And if interest rates go up, then that's when it's going to go down. This pain is going to be felt across all global investors, particularly global investors. Now, Pioneer portfolios, we shortened duration. We were at about 3.5, 4. So we were anticipating some of this increase. Not all, it didn't happen as much as it can, but we still needed some duration risk in our portfolios, because if you go under 3.5, 4, it's very difficult to sort of make any money. So we need some exposure there. High yield bonds, which are the risky bonds, the junk bonds, classic blend between equity and bond. You get a pretty flat result for the quarter. Hedge funds, 1.2% positive, but nowhere near as positive as the stocks. And that's a very typical story for hedge funds. When you blend a whole lot together, they tend to do better on the downside. So if US stocks were negative, then hedge funds would be showing some value. But there's no ways that the hedge funds can keep up with a rising equity market. There's just no way. They're too expensive. They're too diversified. Another interesting one is the listed USA REITs, okay? We hold REITs in our portfolios via an ETF called VNQ. We were under a lot of pressure, a lot of clients complaining at the end of last year that why are we holding REITs in the COVID world where, office space is looking pretty pessimistic, retail space is a disaster, et cetera, et cetera. We held on to that, and in this quarter at least, it was the best performing index around. So I'm pretty pleased with that we didn't succumb to that pressure. It just shows that, not everything in the market is what the rumors say. This slide I came across, and I think it's important because people tend to paint equities with the same brush. They say equity risk is the same, okay? And this slide shows what happens in equity markets over relatively short term. From the left-hand side is what happened from the peak of the virus, which was 23rd of March 2020, till the announcement of the vaccine, which coincided with Biden's election, okay, around about the same week. So we see the high growth stocks on the left did exceptionally well. Then what the market did from that date till March, you can see the growth stocks lost, but the value and the core stocks made money. So the point here is you just got to be careful about considering all equities the same. They're not. Equities are going to behave differently, and we shouldn't throw the baby out with the bathwater if you wanted to reduce the risk. Okay, so what does this mean? As long as interest rates remain low, and I believe 1.7 is still low, it's a low number. For 10 years, 1.7, it's a low number. Pre-2008, we were used to 5-6% for the same thing. So as long as interest rates remain low, then we expect valuations to be high. So if you're going to use valuation metrics, I'm an accountant. One of my least favorite valuation metrics is the price earnings ratio. Okay, it's the most quoted. but it's the least reliable, but it's a measure of valuation. So if the price earnings multiple of the S&P 500 is, say, it's around about 30, that means 30 years worth of current earnings are reflected in the price of the companies on average in the S&P. That might sound outrageously high for you, but we have to understand that 30 in an environment of low interest rates is kind of like the equivalent of 20 or high teens in a normal interest rate environment. So we're just going to have to get used to trading at higher valuations. The NASDAQ is at a crazy price earnings multiple of nearly 60. So very, very concerning valuation metrics. And but we just got to get used to it, I think. Okay. Inflation, I'm going to talk about this in a bit more detail, but I believe that so inflation between 2% and 2.5% is going to be good for equity markets, particularly the good, strong companies, the value companies. Okay. Economists and market participants are very, very sensitive to changes in inflation. So you'll read about in the newspaper, inflation headlines, blah, 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 and it'll be a tiny increase. So just for example, we saw a massive sell-off in treasury bonds in February. Inflation went from like 1.9 to 2.2. Okay, nothing, really, really nothing, but a big sell-off in bonds. So I think that as long as inflation remains under 2 to 2.5, equities will be fine. As we approach 3, the Federal Reserve will step in and start applying brakes. And I'll talk about that in a bit more detail. I mentioned this other point earlier about a risk-off event. If something happens and the market sells off, there's tons of money just waiting to squeeze out a return and will jump back in. So I really believe that we've got a strong market volatility dampener in the background. And therefore, I'm reasonably confident for equities for the remainder of 2021. Inflation. All right. So this is, you can see on the right-hand side, I've got a $50 billion Zimbabwean note there, which is actually given to me by a client to remind me about inflation. I really, really don't believe that hyperinflation is the issue here. The developed world knows how to control inflation, okay? So all you do is increase interest rates. It applies the brakes to the economy. It's painful, but it works. It controls inflation, okay? So hyperinflation is not the issue. You can forget about the $50 billion or the kids playing with blocks of cash post-World War I in the bottom, all right? The Fed has said 2% is a healthy number for inflation. For the last 10 years, we've been running behind. So they're comfortably going to let inflation go above 2%, as I said, closer to 2.5%. And we're running hot. We're running hot on inflation. So the pressure to apply the brakes to the economy is already there. I do not believe they're going to apply the brakes anytime soon, certainly not in 2021. And the first signal we're going to look for on that is full employment. Until the USA gets back to the pre-COVID employment levels, I'm not even concerned at all about them applying the brakes, because they first want to see those employment numbers come, or unemployment numbers go way, way down to pre-COVID levels. There are various inflation measures, inflation that we feel as consumers and your weekly basket of goods. That's not so much my inflation measure. I think more about asset inflation, and that's how much are assets that we buy, whether it's property or stocks, how much are these things going to respond to the government stimulus that's been thrown around. The obvious question is, what asset classes work to protect your portfolios from inflation? So you heard me completely diss gold, all right? So gold's out of the question, cash is out of the question, long bonds are out of the question, okay? So those are all no's. So what? Yes. Bitcoin, also a no. What? Yes. So I believe that good quality companies, value stocks, the likes of Apple and Microsoft, for argument's sake, will be a good source of inflation protection. They're strong companies with strong products, if they'll just increase their prices and you'll be fine. Property is also a physical property is also a place where you might enjoy some inflation protection, on condition that you're not over levered or that your leverage is too sensitive to rises in interest rates. Okay, but I do think that is one asset class that could work. The other asset class is just the higher yielding alternatives, right? Which include property and property linked debt and things like that, which I'll go into in a bit more detail. Simply because they got a higher yield, we got a better chance of beating inflation with those sort of things. So bottom line, don't be concerned about inflation, especially for this year, and keep an eye on things as we approach sort of 3% of the official inflation. The next question I'm getting from clients is, can we still make money when we're buying objectively expensive equities? Okay. And it's a tough question to answer with confidence. And the bottom line is, yes, I do feel that we can make money with equities. We will need to ride out the volatility. Okay. So one has to have an honest conversation about what could happen when that risk off event comes. And one has to manage that risk through the allocation towards those equities. But I do think that for the inflation reason, for the fact that we're very confident that we're going into a high growth environment. Okay, we're there, as I said, because of the government stimulus, even if it is artificial, there's a tremendous boost coming. So we're expecting really high growth. Okay, highest we've seen in a very long time. That's going to be good for equities. Companies are going to enjoy that. Companies are going to make money. And maybe those valuation multiple metrics that I mentioned, maybe they'll come down a little bit. Just to put in some reference here, on the right-hand side here, I've got some different time periods. 2011 to 2021, if you were invested in the S&P 500, you would have made 13% per annum. Some of that is post-2008. Some of that is because of the monetary policy injection. Bottom line, still an outstanding result. 1960 to 1980, you would have made 8% per annum in the S&P 500. But in those days, interest rates were around 6 or 7%. So your equity risk premium wasn't really worth it, but still no one would have complained with 8% per year. From 2000 to 2020, that 20-year period, if you were in the S&P 500, you would have made 6.6% per annum. And inside that 20-year period, there were 5 very, very significant crises. We had the dot-com bubble bursting in 2000. We had the financial crisis of 2008. We had the European crisis of 2011. We had the Chinese Trump Twitter crisis of 2018. And we had Corona in 2020. So with 5 massive hits, completely passive, not trying to time the market, not going in and out, just buying it in 2000, holding it to 2020, you would have made 6.6% per annum. None of my clients would complain about that. My assumption for equities is going forward is that 6% is achievable. I've held this view long before Corona, long before government intervention of the standard. It's simple. 2% growth, 2% dividend, 2% inflation. That gives you 6%. That's what we expect to earn on our equity allocation. Some of my banks that I follow and other research centers actually use higher assumptions. But even if we get 5% compared to where bonds are at, that would be absolutely fine. So value stocks are, I believe, have more room to catch up. They've been lagging over the last few years. It's interesting that the line between value and growth has blurred. Historically, a typical value stock was like Caterpillar, right? Global brand, strong company, strong product, strong balance sheet, low growth prospects, and low valuation metrics. Today's world, the main value players are Apple and Microsoft, which are tech companies. So if we have some sort of risk-off influence in the tech space, Apple and Microsoft are probably going to be affected, obviously to a lesser extent because they're so strong. But the point there is the lines between value and growth have become blurred. So I do think that value has still got a way to go. tech stocks, even with their very high valuations, still have a place in the portfolio, because it's not so much about the starting valuation of where we're at today, which is high, we recognize that, but it's about the growth prospects going forward. And if those growth prospects are strong, then there's a place in the portfolio for a tech or NASDAQ allocation. We do expect it to be more volatile, right? But it still has its place in the portfolio, particularly for some of the technology themes which are so difficult to identify early on. You know, cloud technology, artificial intelligence, all these things that are being thought about. Eventually, there'll be a winner, and that winner will end up in the NASDAQ. So we'll benefit that way around if we're unable to identify it early on. Okay. A few words about the Israeli market. So we expect the Israeli market to follow the global trend. Israel, with our unique position with the virus, the services sector, tourism sector will recover sooner. The story this year, 2021, is all about the corporate bond market, okay? The corporate bond market in Israel, the recovery was later. So if you held a shekel corporate bond portfolio, in 2021, your returns were actually positive, right? As compared to what I said about a global portfolio, where corporate global bonds, the returns in Q1 were probably negative, not probably, they were negative, okay? Because of the rising interest rates in dollars. We didn't see that so much in shekel. So shekel portfolios did better than dollar portfolios in Q1 2021, okay? Rates are likely to stay low, okay? So when you talk to your bank and you ask for what percentage am I going to get on my shekel deposit, don't hold your breath. You're not going to get anything interesting there. So one of our most popular services is a low risk corporate bond shekel portfolio, where at least the probability of capital loss is low, and the probability of beating net of cash and taxes and everything, the probability of beating cash is relatively high. So we're doing quite a lot of that type of work. And very, very important to probably the listeners on this webinar and for our English-speaking clients is the dollar shekel exchange rate, okay? It's very difficult to predict. We're now range bound between 325 and 345, maybe even 335, okay? That's the range that we're in currently. And I think in the short term, we'll stay more or less there. But if we take a longer term view, I've been in Israel 21 years. 20 years ago, the range was 4 to 4 point something. Then we got used to a range of 3.7 to 4. Then we got used to a range of 3.5 to 3.7. Then we got used to 3.4 to 3.6. I think that trend will continue. I think the fundamentals of Israel relative to the United States, we are on a strong growth track. And I think 3 to 5 years down the road, we might have to get used to an even stronger shekel. At least all the signs are pointed that way. Obviously, things could change, but we need to get immigrants to Israel who have assets in dollars, or perhaps enjoying the 10-year tax-free, really have a challenge now deciding what percentage of their wealth to be in dollars and shekels, because the trend, and it's not just our view. Recently, we hosted a call with the founder of the market, his view too. The fundamentals of Israel are strong, and therefore we think that the trend will continue, and this raises some very serious financial planning questions for many of the listeners on this webinar. Okay, Bitcoin, digital assets, and other bad ideas. Bitcoin is old news. I'm a bit of a Bitcoin skeptic. I respect all those people who bought Bitcoin and who made money on it. I could not buy it because it didn't meet, very simply, it didn't meet the criteria or that I would for any asset that we include in our portfolios. So interestingly, a very small number of people actually control about 90% of Bitcoin. So Bitcoin in Q1 hit $1 trillion, of which 90% of that, so 900 billion, is controlled by approximately 300 people. I would venture a guess that it's even less than 300 people. So don't feel terrible if you didn't buy, if you're not one of those 300 multimillionaires from Bitcoin. The problem with Bitcoin is the value can disappear overnight with a simple change of law from the US. The flip side is, I think that Bitcoin and other digital currencies are here to stay. They're not going to disappear. They're here to stay, and they're going to provide noise. Some clients will want to invest in it. We know how to invest should a client request, but we don't want to include it in our model portfolios or in our thinking, simply because, as I said, it doesn't meet our criteria. Other things happening in the digital space are very, very interesting too. So when Bitcoin came out, we said that the technology behind Bitcoin, which is this concept of a blockchain, which is all fancy language for very secure mechanism, so of owning an asset. So one of the derivatives of this blockchain thing is the ability to own an asset very, very, very securely. And therefore, people want to own digital things. So you can claim ownership of a digital thing using blockchain technology. No one can hack that. No one can steal it from you. And we're seeing, and I think this technology is an interesting development. So there's this new buzzword called non-fungible tokens, okay? Yes, I had to look it up. And fungible is transferable. So non-fungible means that you own something, you can't transfer it, you are the owner using that blockchain technology. There's two examples of where this is happening. The picture on the right here was basically a JPEG, okay? A simple digital image that you can copy and paste off the internet for free. This thing was sold for $69 million, paid for in cryptocurrency called Ethereum. Don't ask me why, but somebody thought that that was worth that amount of money. Kings of Leon, a rock band, have released their latest album, and you can buy the album using this NFT. One interesting way that this technology is going to be used in the future is if you're an artist and you produce a painting or a song or something like that, if you sell the painting, the future value gains of that painting are not yours. They belong to the person who bought it from you. So using digital technology and what they call smart contracts, an artist can keep part of the future gains of his art. And I think that's one area where we'll see some of this technology come through. For the removal of doubt, Pioneer is not looking to buy cryptocurrencies or NFTs or any of these funny things. However, what we are looking for is the companies that will benefit from this and the companies that will make money. And as sometimes these might be, for us making an asset allocation play, that might be buying mid-cap NASDAQ stocks. And one of those will emerge as the winner in the NFT space, whatever that means. But we're not directly in the space, but we are looking out for it. And again, it feeds back to the allocation to the NASDAQ that you want to have these things in your portfolio, even though they're expensive, because they do capture on the widest possible basis, they do capture these type of technology themes, which are so difficult to identify when they are cheap. So that's one more reason to hold the NASDAQ. Okay, so as I've indicated, there's a very strong macro environment. What's the problem? And I hinted at this a couple of times. Quality bonds are simply too expensive, okay? Inflation and rising rates will be bad for bonds, especially these long bonds. It's a problem we see all over the world. Dollar, shekel, euros, the yields are simply too low for your average investor, particularly conservative investors, okay? And conservative investors tend to have a large percentage of their portfolio in bonds historically. Now, this makes a major, major dilemma for a conservative investor. how does he achieve his return targets if he doesn't want to take risk, or he's concerned about risk and wants higher returns? So it's a big dilemma, and one has to be sort of honest about the situation. You either buy equity, and as I said, have the maximum amount of equity that you can tolerate from a risk point of view, or you start allocating to alternatives. Alternatives. Pioneer, we're doing more alternatives than we've ever done. It's a different risk return profile. You're expecting a higher return. Some of these products might be unregulated, they might be illiquid, they might be expensive, they might have leverage in them, they come with all sorts of complexity. But if you want higher returns, you need to allocate to different things, including alternatives. Okay. Just to illustrate graphically the bond problem, this bar chart is 6 categories of bonds, which pretty much covers the bulk of the bond market. The left 3 are government bonds. The light blue bar is the yields in September 2007. And then the other bars are closer to where we are now. So 2012, September 2020, and then March 2021. If I direct your attention to the 4th sort of bar here, I don't know if you can see my mouse, I hope you can. It's 1 to 5 years, so relatively short-term investment grade bonds. This is the bread and butter historically of asset management for conservative clients. That's where we, companies like Pioneer and around the world, that was our playground, okay, for conservative clients. Look at it now. 10 years ago, you would get 5.4% on a broad exposure here. Today, you're getting 1%. 1% is not enough for most clients, and therefore, that's the problem, okay? So bonds are the problem. And that leaves us back to alternatives. Just to remind you all what are alternatives. So property, as I said, illiquid, leverage, often unregulated, property-linked debt, at least the debt, the lending has some sort of collateral, okay? So that's a good thing. That's one type. Consumer credit, that's typically unsecured loans, small amounts between $10,000 and $30,000, highly diversified for each loan, I mean. And they charge very high interest rates. It's in the US. The lending is all based on the credit scores of the underlying people. And they charge very high interest rate. There's some fees. There are some defaults, but you're expected to get above 5% after all of that. Structured notes. I'm a big fan of structured notes. You can watch some of the previous webinars we've had on structured notes. I think the structured notes are a wonderful blend of stocks and bonds. You take the volatility of the stocks with the infrastructure of the bond, and you come up with a blended result with predefined outcomes. One of the most wonderful things about structured notes is you know exactly what you're getting. Okay, if this happens, you get this. If X happens, you get Y. So it's all predefined at the beginning, and that makes it an easy way to get a higher return with a level of risk that you can live with. Hedge funds, as I said earlier, hedge funds tend to show better results in a negative equity market. They'll never keep up with a rising equity market, but they do have their place in a world where bonds are giving you nothing. So perhaps you can swap the conservative nature of a bond with a good grouping of hedge funds. Never too many eggs in one basket, but perhaps through that you can get higher returns without taking on too much risk. Okay, just to conclude and wrap it up before I answer some questions. As I said, optimistic about the overall scenario. I'm expecting very, very strong growth numbers through Q2 and Q3 of this year, even if the virus is sort of hanging in the air because of the government intervention. Slowly, we're going to see a return to normality. Israel, obviously, much before the rest of the world. And and I think the strong growth in 2021, at least, will outweigh the inflation fears. And inflation is more of a problem for the future than for 2021, in my opinion, even though we've seen a lot of pain in February this year. We're still cautious about the COVID losers, for example, airlines. So we haven't made any plays. The COVID winners we enjoyed via NASDAQ exposure, but COVID losers, I'm not ready for buying airlines. I think there's a lot of pain still because I've been trying to book flights and you just can't plan ahead. So I don't know how they run their businesses where everything, the rules are just changing every few weeks. So the rising rates, which we anticipate, but not terribly high from where we are currently, I think that'll be better for the value stocks than the growth stocks. And the growth stocks are going to be volatile. So if you have that NASDAQ line in your portfolio, you need patience because it's going to be up and down all over the place. And obviously I said we don't like gold or Bitcoin as places to protect your portfolio. That's all. I hope that was 45 minutes, a little bit more than I thought. Let's have a look at the questions. Okay, we've got a question about the REITs. By property and sector loser, I'll have to answer this one offline. I don't have that information offhand. And I hope I answered all the questions. We got a question about in the registration process about given the higher level of volatility, should one reduce equities? Okay, this is what this presentation is about, is that you can't time it. And equities are not all the same. So one shouldn't think about selling equities. If you're really concerned, then you can sell the high valuation, high growth stuff like a NASDAQ, and you can have your equities, but have the more conservative equities. But I would not be selling equities down. Equities are going to be, if we have this discussion in 5 years' time, your returns are going to come from equities, not from bonds. So I would not be selling down bonds. I would equities. I would just be rebalancing within the equity allocation. Okay, thank you all. That concludes the questions. Again, this will be available on YouTube if you want to watch it again. And we remain at your disposal to answer any questions. Thank you again for the time. Have a pleasant evening and stay safe.